Good afternoon, and welcome to the FIA Milliman webinar titled The Impact of the Recent Market Downturn on Municipal Pension and OPEB Plans and What You Should Be Thinking About Now. I'm Chris Rawlins, Managing Partner and Senior Consultant at FIA, and I'm joined by my colleague Kate Peasy, Senior Consultant at FIA, and Becky Seelman, Principal and Consulting Actuary at Milliman. On behalf of all of us at FIA and Milliman, we hope you and your family are staying safe during these uncertain and trying times. Given the recent market volatility, today's webinar will review capital market performance and what this may mean to the funded status of municipal pension and OPEB plans. We'll also provide tools and guidance that you may want to consider in helping to mitigate the impact of the recent market downturn on your financials. Before we address first quarter capital market volatility, we thought it would be helpful to recap 2019 market performance and its impact on the first 6 months of the fiscal year and look back on the strength of the 11-year bull market. We close out the fourth quarter in calendar year 2019 on a positive note as easing trade tensions between the US and China, accommodative Fed policy, and generally a supportive economic and corporate backdrop served to fuel investor sentiment. The S&P 500 advanced 9% for the quarter and returned 31% for the calendar year, while fixed income, as measured by the Barclays Aggregate Bond Index, advanced 8.7% for the calendar year. As a result, pension and OPEB portfolios posted solid single-digit returns for the first 6 months of the 2020 fiscal year. That would be July 1st through December 31st. And these returns tended to profile between 5.75% and 6.75%. So most plans were off to a good start for the first 6 months of the 2020 fiscal year. As we look to 2020, we remained relatively optimistic that capital markets would likely grind higher given generally supportive economic and corporate fundamentals. Yet we cautioned expectations for more restrained investment returns with bouts of heightened market volatility given valuations and late cycle investing. To put the 11-year bull market into perspective, you can see on this chart the return trajectory of the S&P 500 since the global financial crisis back in 2008-2009. Despite periods of volatility and, of course, first quarter's most recent sell-off, the S&P 500 has returned approximately 360% from a low in 2009 through May 8th of this year. This tremendous run, not only for the S&P 500, but equities in general, helped to shore up the funded deficit for many municipal pension plans. So let's turn our attention to the first quarter of this year as equities sold off in dramatic fashion, and we also look closely at the catalysts behind the bounce back as well. As depicted in the chart, the S&P 500 hit a peak of 3386 in early February, and then shed 34% in just 18 days as volatility, as measured by the widely cited VIX, reached historic high levels. After hitting 2237 on March 23rd, the S&P 500 rebounded in dramatic fashion, and we'll look closely at the catalyst behind the recovery on the next slide. As illustrated, we use the same S&P 500 price trend line and note market events, as well as both monetary and fiscal relief during the period. As you can see, in addition to the impact of the coronavirus, the collapse in oil prices also served to exacerbate the sell-off, while swift and decisive monetary efforts by the Federal Reserve through interest rate cuts and multiple rescue or backstop programs, as well as the $2 trillion fiscal stimulus package, served to restore investor confidence toward the end of the month. As depicted, the V-shaped bounce illustrates not only the dramatic sell-off in such a short period of time, but the rapid recovery as well. Important to note on the next slide, while most of the attention at the time focused on the equity markets, the fixed income markets were not immune to the sell-off. As illustrated, non-US Treasury sectors came under intense pressure during the period as investors shunned investment-grade credit and high-yield bonds as an example in favor of US government paper and cash. The Federal Reserve's efforts to provide ample liquidity and keep the fixed income markets fluid has restored investor confidence, and similar to equities, we've seen a meaningful price recovery within the non-US Treasury sectors as well to date. At this time, I'm going to turn it over to Kate to talk more about the benefits of portfolio diversification, why market timing is difficult and often detrimental to long-term investment results. And as we head into the final 6 weeks of the fiscal year, we've modeled a couple of portfolio outcomes under various capital market scenarios to give you a sense of potential absolute return profiles. Kate?
Great, thanks, Chris. As Chris alluded to, there were very few places to hide during the March sell-off, which is why we continue to advocate that portfolios should be constructed both thoughtfully and in a well-diversified manner across asset classes. You might have seen this chart before. It's aptly referred to as the quilt chart. This chart shows annual returns for a range of different asset classes over 15 years, plus 2020 through May 8th. Each asset class is represented by the same color for each year, and best performing asset classes are towards the top with the worst performers at the bottom. The chart illustrates really all major asset classes from stocks and bonds to commodities and cash. And notice kind of cutting through the middle of this chart is a hypothetical diversified portfolio with varying weights across the asset classes shown. But you can kind of view this as about a 65% weight in equities, 35% allocation to fixed income. The two columns to the far right show annualized returns from 2005 to 2019 and volatility for each asset class over that same period. So a few key takeaways. First, notice that there's really no clear pattern to the asset class outperformance or underperformance from one year to the next. It would have been impossible historically to predict with certainty what the following year's top performing asset class would have been. In some instances, you'll see in one year, a particular asset class was at the top of the column to then fall all the way to the bottom the next year. This was the case more recently for emerging market equities in 2017 to 18. And you'll notice this again in cash from 18 to 19. So also notice the diversified portfolio really never falls either in the top nor at the bottom, showing really that diversification is doing exactly what it's supposed to do, effectively smoothing out that volatility. And notwithstanding, the past 15 years did not lack volatility. We had market crashes, wars, natural disasters, unexpected geopolitical events, and really despite all of that, staying fully invested in a well-diversified portfolio would have achieved a pretty impressive average annualized return of 6.6% with a standard deviation or a volatility number far below many of the other asset classes. So with the rapid bounce back in late March into April, portfolios that performed best were the ones who had the wherewithal to stay fully invested, and in some cases even rebalance back into equities. That discipline to remain invested and avoid that urge to get out of the market has proven to benefit long-term investors, which is shown on this slide. Like attempting to avoid the market's downs may mean missing out on the ups as well. So nearly 75% of the stock market's best days occur during a bear market or during the first 2 months of a following bull market. This graph shows you that if you just missed the market's 10 best days over the past 39 years, the growth in your portfolio would have been cut by more than half. And that's, again, just missing those 10 days. Missing 50 of the best days would have reduced your returns by really a pretty astounding 90%. Market timing is an easy game to get wrong. There really are two trades you need to get right. First, when to get out of the market, and second, and arguably much more difficult, when to get back in. And the consequence can be painful if you get either side of this trade wrong. So unless you know exactly when the market's going to turn down and turn up, the best course of action is frequently to stay the course. So let's look at portfolio performance. On this slide, we're showing fiscal year performance based on a hypothetical 60-40 global portfolio going back to 20 years. And that's shown in these orange bars. Notice only 4 out of the 20 years posted a negative fiscal year return. But I think worthwhile to highlight is also the blue line, which represents the trailing 5-year annualized return. So even amid the volatility that we experienced really over these past 2 decades, at no time has this trailing 5-year falling into negative territory. So many public pension plans employ a smoothing technique to calculate their contribution requirements. So this is certainly a bright spot in what I would categorize an otherwise dim quarter. Then notice the kind of lone green bar at the far right-hand side. This bar represents the return for the first 3 quarters of fiscal year 2020. So July 1st, 19 through 3/31/2020 for a representative 60-40 portfolio. See that portfolio for those 3 quarters returned a negative 6.6%. But I'm sure everyone joining today knows what really matters is not necessarily what has happened within the fiscal year, but where the assets are finishing the fiscal year. So what we've done in this next slide is to show what 3 representative portfolios might look like under various return assumptions for this last quarter of the fiscal year ending 6/30/2020, or the second quarter of the calendar year. So even though we're just 6 weeks from closing fiscal year 2020 books, and returns have been really extremely strong since March 31st, as Chris pointed out, it will likely not be a smooth ride to this close. And we've certainly seen some evidence of that continued volatility this week. So we looked at 5 scenarios for equity market returns during this last quarter of the fiscal year and their impact on 3 portfolios. So the return scenarios that we're looking at for the portfolios are down 5%, a portfolio return in this last quarter of flat, up 5%, up 10%, and then a scenario where the portfolio returns really the inverse of what was experienced in calendar year Q1. For a portfolio that's allocated 75% to equities and 25% to fixed income, the portfolio really return would need to be higher than about 10% in order to generate a full fiscal year return for 2020. And looking at a 60-40 portfolio, so 60% equities, 40% fixed income, that break-even number is about 7%, and you can see those other scenarios fall around that number. And then finally, on a 50-50 portfolio, that returns, or kind of that break-even return for this last quarter of the fiscal year, must be about 5%. So anything beyond that would generate those positive returns on the fiscal year. So while there's really nothing you can do to alter historical performance, there certainly are areas that we believe you should be thinking about with regard to your investment portfolio going forward. So just quickly noting some of those. First, reconfirm that your risk tolerance aligns with your wherewithal to remain invested through this market dislocation. And if it doesn't, then really look to reassessing your asset allocation. Keep enough cash on the sidelines to cover the pension's obligations over the next 2 to 3 months. Make sure also that your money market fund that you have in your portfolio is in fact a government money market fund, in order to provide principal protection that's coming from government money market funds rather than prime money market funds. And also to know, we may see money market funds start to waive some of their fees again in order to keep returns from going negative. We saw this coming out of the great financial crisis. Also have a disciplined rebalancing plan that has triggers or set rebalancing guidelines around that, and stick to that plan. I think that that's really important to make sure that you are in fact following that plan, especially in times of crisis. And then from a risk mitigating or downside protection, hedged equities utilizing put call options may certainly provide some downside protections, as can long-term treasuries, but just be aware and realize that this protections can certainly come at a cost. So while we don't have the ability to change history, I think one of the bright spots is your actuary may. And in this next section, Becky will review some of the things that you should be thinking about on the actuarial side to help mitigate some of the impact that this market has had on your financials.
Thank you, Kate. First, I'm going to talk a little bit more about the past. Actuaries drive looking in the rearview mirror, so the past is always important to us. I'll talk a little bit about some things to think about in terms of when your valuation is done. Then we'll talk briefly about the very important asset smoothing policy. And finally, we'll spend some time on amortization policy and some changes that you might be able to make to help mitigate the impact of market losses. So first, I want to just provide some more historical perspective from the Milliman Public Pension Funding Study, which looks at the 100 largest US public pension plans. Now, first off, this isn't municipal pension plans in Connecticut. These are very large pools of assets that invest much more than smaller municipal plans do in things like private equity. And private equity has a lag in when they report returns. So our numbers for the 100 largest US public pension plans, for many of those plans, do not reflect how well or poorly private equity has done so far in 2020. So with that in mind, the first quarter of 2020 was certainly a down period for these plans. Our estimated return is almost negative 11%. Which is only half as bad as the financial crisis, but still worse than anything we've seen since then. On the other hand, April was a bright spot, and just published on Wednesday of this week is we did a special April 2020 update because markets recovered considerably. And again, these aren't your numbers and do reflect lagged reporting from things like private equity. But for the asset classes where we do have performance numbers for April, what we're seeing is that April saw a regain of about half of the losses experienced in the first quarter. So a little bit of good news there. I keep track of 12 Milliman public pension plans in Connecticut and Rhode Island that we have known since 1994, and I plot all of their returns to provide a long-term view. And it's important to note that as we got through the end of fiscal 2019, that was the end of a very good period with strong returns on a compounded basis for 2010 through 2019. These plans had a compound return of 10.2%. There were certainly some ups and downs in that period. That's the market. I think it's also interesting to look at the most recent years on the right within the box and compare the pattern of dots to what we saw much earlier on. And what I see is much more closely aligned returns across plans than used to be the case. Back in the 90s and early 2000s, we had much more variety from plan to plan in terms of their returns. And we see much less now. I take that as a sign that more and more public pension and OPEB plans are using expert investment consulting to help guide them and have more disciplined and a better diversified portfolios than used to be the case. So we see much closer scatters than was once the case. It's also interesting, I looked just at a dozen of those plans to compare, that dozen plan, that set of a dozen plans, I should say. I compared just 2010 through 2019 with the fuller 25-year period. And again, the last 10 years really do look different from the years that came before. And one of the characteristics is that over the last 10 years, the plans as a group, these are our orange dots on this graph, had generally higher returns, that's from top to bottom, with less volatility, that's left to right, than was true over the entire 25-year period. Over 25 years, the compound returns are lower and there was more volatility, more variation from one year to the next in terms of returns. So we are coming off a nice, steady, quiet decade in terms of investment performance, which has maybe lulled us into this sense that investments are predictable. And of course we know they're not. So Chris, if you would go to the next slide. I'm sorry, we will go into in a few minutes into a discussion about why asset smoothing is so important. But before we go into that, I want to talk about timing, the timing of the valuation date relative to the fiscal year for which we are determining the contribution. And this is information you'll want to tell your elected officials about to calm concerns about when the impact of the market downturn will hit budgets. And first, I want to go through a traditional arrangement where valuations were done as of the first day of the fiscal year to determine the contribution for that fiscal year. So for instance, a July 2019 valuation was used to calculate the contribution for fiscal year starting on July 1st, 2019. That is not a desirable state of affairs. You do not want to know in the middle of a fiscal year the actuarially determined contribution for that fiscal year. That really throws a wrench into budgets because you get a budget variance. You may estimate a contribution, but then the final contribution ends up being different. So because of that undesirability, what most municipal pension plans have switched to is what's illustrated on the next slide, Chris, if you would, which is to have a 1-year lag between the valuation date and the start of the fiscal year for which the contribution is being determined. So for instance, a July 2019 valuation is used to calculate the contribution for the fiscal year that starts on July 1st, 2020. And the significant importance of that in today's context is that the current market downturn will be reflected in the July 1st, 2020 valuations, which will calculate the contribution for fiscal 21-22. So remember, if you use a 1-year lag, that your contribution for the upcoming fiscal year is not impacted by the market downturn. The first fiscal year that you'll feel that is in 21-22. And even for some plans, we only do valuations every other year. And if you have biennial, every other year valuations in odd numbered years, you've just had a 2019 valuation done that calculates your contribution for 2021 and 21-22. So the first year you will feel the impact of the market downturn isn't until 22-23. Now, returning back to the topic of asset smoothing, as we saw, the markets can be very volatile. Here's one plan of my 12 that I showed you with market returns, some very great years, 20% returns or more, some very bad years, and negative 15% return during the financial crisis, some years where the returns are close to zero. The current fiscal year looks like it may be another red dot kind of year with a negative return. But when we use asset smoothing to calculate the plan's funded status and determine the actuarially determined contribution. Well, here you can see that the orange smoothed returns are, well, smoother than the market returns. And that's exactly why we do asset smoothing, so that the contribution is insulated somewhat by market volatility, because the last thing that municipal budgets can withstand is contribution volatility. So 5-year asset smoothing, 5 years is kind of a sweet spot. It provides good smoothing, but the actuarial or smooth value of assets doesn't stray too far from the market value. There are some plans that use 4-year smoothing. 5 years is the overwhelming choice with governmental pension plans. And you can see that in no time period, to repeat Kate's point, in no time period did the smoothed return ever fall below 0. And in fact, if you look at the years immediately before and after the financial crisis in the middle of the page, there were 2 years with negative returns, followed by 2 years with very, very strong returns. And that's the whole premise of asset smoothing, that we will have down years and we will have very good years, and they're likely to be within the same 5-year period that we'll see both. And they will balance one another out. So you can see that these smoothed returns in the 5 years after the financial crisis, while they weren't great, they were negative, never negative. And the average return for this entire period for this plan happens to be 6.5%, which is our assumption about future returns for this plan. So thus, you illustrate the advantage of market smoothing. And in a year like this, when you've had a market downturn, just remember that whether the market delivers pain or pleasure, you'll only feel that gradually. A couple of key things to remember about the asset smoothing technique. First of all, when we measure market returns, we net all investment expenses. So we're looking at capital gains and losses, interest payments, dividends, net of all investment expenses. And the second important point is that from an actuary standpoint, when we look at gains or losses, we're looking at them relative to what we expected the assets to earn during the year based on the interest rate assumption. And I just have a very simple numeric example here. I've simplified things to make the math easy. Suppose we have a plan with $10 million of assets at July 1, 2019. And suppose, again, for simplicity, that the net cash flows are 0, that every dollar coming in contributions is balanced by a dollar coming out in benefit payments. And let's use an interest rate assumption of 6.5%. So when we stand at July 1st, 2019, we expect that in that coming year, the assets will earn 6.5% of $10 million, or $650,000. Now, suppose that for this current year, the actual market return is negative 10%. Again, that's a round number. We hope it's not that bad, but just for round numbers, if the market return were negative 10%, instead of the assets earning $650,000, they actually lost $1 million. For our purposes, for calculating the smoothing, we look at the difference between that expected $650,000 earnings compared to the actual $1 million loss. So what we measure as the loss is $1,650,000. Now, if we have a 5-year smoothing period, we'll gradually reflect that $1,650,000 over a 5-year period. So in year 1, when we do the July 2020 valuation, we're going to effectively pretend that 4/5 of that loss didn't happen. We'll take 1/5 of it, or $330,000, and recognize it at July 1st, 2020. And then in each of the next 4 years, we'll similarly recognize another 1/5 of that loss. And hopefully, sometime in the next 4 years, there will be some market gains to balance out this market loss. But remember that you're not home free just because your return for this fiscal year is above zero. What matters is where your return lands relative to the 2019 interest rate assumption. Okay, now on to amortization policy. A large component of the actuarially determined contribution for many of you is a payment to pay off the unfunded accrued liability. And remember that whenever we talk about amortizing the unfunded accrued liability, it is very much the same math and the same mechanics as a mortgage for your home or a bond that your municipality issued. So I find it helpful to translate actuary speak into mortgage speak whenever we talk about amortizing the unfunded liability. The first thing you can consider doing to help mitigate the impact of the market downturn is lengthening the amortization period. If you have a longer time to pay off a loan, each year's payment is lower. So if, for instance, we have a 10-year amortization schedule, you could consider lengthening, say, to 20 years. These are just round numbers. This isn't a recommendation. If you lengthen the amortization schedule, the annual payments will decline, but of course, it will take you 10 more years to pay off the unfunded accrued liability and get to a 100% funded plan. So the trade-off is between having lower payments for a longer period and having a longer period of time to get to be fully funded. Another thing to consider is the amortization growth rate. A mortgage is a level dollar amortization. You pay the same dollar amount in every year of a mortgage. But when we're funding public pension and OPEB plans, we can have an amortization schedule where the amortization payments go up over time by design. And the idea is that the amortization payments will grow over time at perhaps the same rate as your other compensation and benefit costs. So relative to the overall budget, they're remaining constant as on a percentage basis, even if they climb as a dollar amount. Now you should consider the extent to which you can afford an element in your budget that by design is going to go up over time, and how much of a growth rate your budget can manage. So if you are a municipality that is struggling to maintain grand list and has other significant costs that may be climbing over time, it may not be prudent for you to plan on having a pension payment that's going to go up year over year, certainly not at a fast rate. For your community, a level dollar payment schedule may be the most prudent. On the other hand, if you're anticipating growth or experiencing growth now, you may be able to manage a growth rate in the amortization payments along the scale of your growth in payroll or other benefits costs. If an amortization payment is going to go up over time, it will start out lower in the short term. So increasing the amortization growth rate will reduce the payments in the short term in exchange for higher payments in the long term. The unfunded accrued liability is always by design going to go down to zero, and the plan will get to 100% funded at the end of the amortization period. In this case, I'm illustrating a 20-year period. But depending on the amortization growth rate, the unfunded accrued liability is going to drop down to zero over different pathways. The more you're contributing, the higher the payments in the earlier years, the more quickly the unfunded accrued liability will get down to zero. In particular, the higher the amortization growth rate, the more risk you run that the payments you make in the early years will not be large enough to cover even interest on the unfunded accrued liability, which means that the unfunded accrued liability might actually increase for several years before it starts to decline. That's a situation known as negative amortization, and it doesn't particularly have good optics. So before you just sign on the dotted line for a high amortization growth rate, you need to consider what pattern that will entail for your unfunded accrued liability. You may also want to consider just setting aside the current year asset loss and treating it separately. With many Connecticut municipal pension and OPEB plans, we group all of the unfunded accrued liability together and have a single amortization payment for the whole. But you could segregate the impact of this year's market downturn and amortize it perhaps over a longer period than the rest, or perhaps with a different amortization growth rate than the rest. So whatever amortization schedule you had in place in the past, you could maintain in the future, but just carve out this year's asset loss. That's a very straightforward exercise for your actuaries and may be good from an optical point of view. So something to consider and talk about with your actuary. Now, it's critically important when you make decisions about how to cope with the market downturn to not just look at what changes can be made to reduce next year's contribution, but what it will mean in the long term. I want to show you an example. Here's a typical plan with typical 5-year asset smoothing, the 10-year closed amortization period. The amortization growth rate is 2.75%. On July 1, 2019, they were 80% funded. This picture is what we expected to see standing at July 1st, 2019. We expected to see gradual increases in the actuarially determined contributions by design. Remember, the normal cost component of the contribution goes up over time. This plan uses a 2.75% amortization growth rate. So the actuarially determined contributions were expected to climb gradually until the plan became fully funded in 10 years at the end of the amortization period. Then the amortization payments would disappear and all that would remain thereafter were normal cost payments. So this is a pretty typical picture of what we would have expected back on July 1st, 2019. Now we can layer on top of this what might be expected to happen given the market downturn. So first, we play around with what if we have different levels of returns in the current fiscal year. And the bloodier the news, the more negative returns, of course, the more that will increase contributions over the long term. But you'll note that regardless of which line this year gives us, the actuarially determined contributions will only gradually increase over a 5-year period because this plan uses 5-year asset smoothing. So the impact will gradually emerge over the next 5 years, after which the contribution will continue to climb. But for this plan, without changing that 10-year closed amortization period, regardless of what the current year's loss looks like, the plan will reach 100% funded in 2031. And after that, there will only be normal cost contributions to pay. The larger the loss that we experience in this year, the more the contributions will climb up between now and when the plan is fully funded. So the greater the loss, the higher the peak in contributions over the next 10 years. So you're, in effect, you're paying for this year's loss over the remainder of your amortization period. Now, let's look at what happens if you extend the amortization period. Obviously, the longer the amortization period, the smaller the impact on contributions. This particular slide is illustrating what if the current fiscal year is a negative 10% return. So lengthening the amortization period from 10 years to 25 years provides much lower contributions, the dark blue line, over the next 20 years. But of course, with a 25-year amortization period, you will still be paying amortization payments. You will still be paying for this year's loss for the next 25 years. So there's the trade-off between paying more now or paying more later. That's the fundamentals of funding any pension or OPEB plan: pay now or pay later. One thing I do want to talk with you about is the nature of the amortization period. If you're a Milliman client, chances are you use closed amortization, which means that each year your amortization period declines by 1 year. So for instance, if you have a 15-year closed amortization period, the plan will be fully funded by 2036, 15 years from now. The amortization period will go down by 1 every year. But some plans use what's known as open amortization. That is, every year the amortization period is the same. So it's 15 years last year, this year, next year, always amortizing unfunded liability over 15 years. It's a little bit like if you have a mortgage that you refinance every year for the same 15-year term. So you're always making mortgage payments. You're never done paying off the mortgage. Now, if the plan is fairly well funded with an open amortization policy, chances are good that the plan will reach fully funded, not after 15 years, but after a reasonable period of time. But if the plan is fairly poorly funded, in this example, 60% funded, with open amortization, this plan will never become fully funded. In fact, it will never even reach 70% funded, even 25 years down the road. So it's important to consider the nature of your amortization period. And if you are using open amortization, I encourage you to look at the long-term expectation for the plan's funded status. And if the long term does not include your plan heading towards 100% funded, that's a signal that you should rethink your open amortization. It's also a really concrete illustration of why it is always important to be looking long term at the consequences of your funding policy, whether it's asset smoothing or the amortization policy, to make sure that whatever you choose for your community, it is designed to get your plan to be fully funded after a reasonable period of time. Now, I do want to deliver some bad news to those of you that have very well-funded plans. And the bad news is that as we look at the contribution, at the growth in the contribution from this year to next year on a percentage basis, the better funded you are, the more a market downturn is going to increase your contribution on a percentage basis. And let me walk you through why that is. Let's look at the left-hand side. The graph on the left-hand side is the contributions for fiscal 2021 based on a July 2019 valuation. So this is before market downturn. And we've illustrated what if this plan has different levels of assets. So at the far left, the plan was 100% funded in 2019. So their contribution just consisted of normal cost plus some interest. The total actuarially determined contribution is $1,067,000. Now that same plan, if it has less in the way of assets, so it's less well funded, has the same normal cost, but different degrees of past service costs to pay off unfunded liabilities. So if that same plan has less in the way of assets, it's just 60% funded, They have the same normal cost, but a very large past service cost and a total actuarially determined contribution of $9,055,000. So the same plan a year later with a 10% negative return in the current year, what happens to their contribution? And that same plan that was 100% funded on July 1, 2019 is no longer 100% funded at July 1, 2020. So for the 2020 valuation, their normal cost has gone up a little, but now they also have a past service cost as they pay off the impact of the market downturn. And their actuarially determined contribution is now $2,021,000, which is a 32% increase over the prior year. By contrast, the plan that was 60% funded on July 1, 2019, well, they're even worse funded at July 1, 2020. So their past service cost certainly has gone up, and their actuarially determined contribution has gone up as a dollar amount. But on a percentage basis, year over year, from 955 to 1118, that's just a 17% increase. Not that anyone likes a 17% increase in any line item, but much easier to handle a 17% increase than the 32% increase that very well-funded plan is. So unfortunately for you well-funded plans out there, you're going to see a larger percentage increase. It's not a large dollar increase, but it's certainly a large percentage increase in your contribution. So a couple of things to tuck away, think about, talk over with your elected officials. First, most importantly, don't just look short term, because you have to be okay with what will happen long term because of actions you take now. You need to balance in the short term that your tax base may be in more fragile state than they were 3 months ago. Businesses may be facing bankruptcy, individuals may be facing loss of jobs, and their ability to absorb tax increases may be impaired. Whereas on the other hand, you do have the long-term need to properly fund your pension and OPEB promises. And in particular, you need to work out the question of intergenerational taxpayer equity, of having the appropriate generation of taxpayers pay for the pension and OPEB plans and the benefits that are being earned by today's employees. So the question of shouldering the burden of today's losses is very important. Anything that you do to lessen the burden today is going to increase the burden on the next generation. You should also consider the governance question. When your actuary comes to you and says, here are some ideas I have for how we might change, for instance, your amortization policy to mitigate the impact of the market downturn, you need to be aware of whose decision it is, who weighs in, who provides input on that decision. You also need to think through what else is going on in the financial picture, not just the short term, but also your longer term bonding needs, for instance. When are you going to need to go to the market to finance that high school renovation? Or maybe you already did the high school renovation and those bonds are going to be finished up in another couple of years. That's very important when you think about this other big ticket item, which is your pension and OPEB funding. So think about the big picture. I'd also encourage you to think about an experience study. We talk a lot with our clients about the interest rate assumption, and in this past year about the mortality assumption. But there are other very important assumptions that drive the liability, including the retirement assumption, turnover patterns, patterns of pay growth. An experience study enables us to do a deep dive into those assumptions and ensure that we have assumptions that are doing the best possible job of anticipating what will happen in the future. And if you haven't done one recently, best practice from the GFOA is to have one done every 5 years. I'd encourage you to talk that over with your actuary as well. And then finally, repeating a point that Chris and Kate made earlier, think about, while the pain is fresh in your minds of market risk, consider whether you are taking a manageable, appropriate level of investment risk. Pain is always harder to absorb that when you have a market downturn than the corresponding pleasure of an up year. So when you think about risk, risk means you have some good years and you have some bad years. When you consider risk, think about the impact of a bad year and how easy it is for your budget to absorb the consequences of a bad year. And consider adjusting the level of risk to minimize the impact of future events like the one we're facing today.
Great, thank you, Becky. Some closing thoughts as we conclude today's webinar. I think from a market perspective, market volatility is likely to continue until we see meaningful progress towards containing the virus and reopening the economy. I think from a portfolio perspective, some key tenets continue to hold true. And Kate touched upon some of these: maintain a thoughtful and disciplined approach to investing, avoid temptation to time the market. And as Becky pointed out, if your risk tolerance has changed in response to this market downturn, then a dialogue around revisiting the portfolio's asset allocation is perhaps warranted. As Kate pointed out, consider full or modest rebalancing initiatives to strategic asset allocation targets, and to meet ongoing benefit payments, maintain sufficient liquidity in the portfolio. Consult with your actuary to understand the tools and resources at your disposal to mitigate the potential impact of contributions and on the organization's financials. And then lastly, lean on your partners during these times. We're here for you. Ask questions and be informed. We want to thank all of you for participating in today's webinar. If you have any additional questions, our emails are provided on the screen. We look forward to continued dialogue. And again, thank you for your time.